All right, there are two primary steps whenever we walk through an example. First of all, you do need to adjust financial statements for any years that have been presented. The second thing, as far as this retrospective approach, is you do have to adjust carrying amounts of assets and liabilities all the way back to the first year presented. And so retained earnings is also going to be adjusted, and so you're going to have a lot of adjusted balances as part of this. The other thing you do have to do is disclose the nature of the change and the reason why you made the change. And then also you do have to describe the method. So any prior period information that's been changed, any effect on income, anything like that, you need to disclose all of that information. So again, retrospective changes are pretty substantial. All right, so let's do an example. 49er Company started operations on January 1st, 2019, and they used the LIFO method for inventory accounting all the way through December 31st, 2021. And this was the income as it was reported from 2019 to 2021. Net income in 2019 was $10,000, in 2020 was $12,500, and then in 2021 is $11,000. For those students who are kind of following the lecture, I formatted this a little bit differently than what you see in the problem in your notes, and it's just a little easier to, I think, digest in this format, so that's why I'm using it. All right, so they also have a good question about those steps. Do we need to know how to do the journal entry? I'm not going to be going back a few slides. I'm not going to go in there and say list out the steps. I think that's more just knowing what you need to do and knowing what you're responsible for presenting. So within the context of a test, I'm not going to, it's not going to be that kind of detail. So good question. As far as the inventory balances, there are these three inventory balances in 2019, 2020, and 2021, 4,000, 3,500, and back to 4,000. And so, again, this is all using LIFO. Then they decide we're going to change to FIFO. And so on January 1st, 2022, they make this transition to FIFO. There could be any number of reasons they might make the change. They'd have to disclose those reasons. Excuse me, but they're just making this change. And so what I've done here is in one sort of table, I can show you how the income would have changed had they reported under FIFO in those prior years, 2019, 2020, and 2021. And so you can see that income would have been higher in each year because of that change. And so let's talk about the journal entry. And so the first thing we're going to do is kind of think about that cumulative income. And so I'm going to bounce back a little bit. And you can see that in 2019, 2020, 2021, the accumulated income would have been $33,500. Similarly, under FIFO, if you accumulate income over the same 3 years, it would have been $37,300. So there is a cumulative difference in income between the two systems, and that cumulative difference is $3,800. So under FIFO, the cumulative income would have been more than it had been reported under LIFO. And so this becomes really important to understand when we make the journal entry, because if there's a cumulative effect, you absolutely need to be able to follow the accumulation of income, and we're going to see where that accumulation shows up in the journal entry next. Maybe. We're getting there. All right, here we go. All right, so what accounts are going to be part of this journal entry? First of all, retained earnings. Because there's been a change in our cumulative income, there will be an effect on our retained earnings account balance. And then the other piece of that is going to be inventory. And this has to come from your intuition. So anytime we have one of these problems, there's really not an easy way to memorize what you need to do. You really kind of need to think about what accounts are going to be affected by this change. And we can hopefully see another question in the stream that I want to answer since it came up. What if they gave cost of goods sold instead of income? Essentially, those are synonymous for this particular example. So because the inventory effect, I could have just as easily said there's a change in cost of goods sold as I could have said there's a change to income. And so those two things are kind of synonymous. And so in this case, I just went with income. I think in the previous or the other lecture, I did cost of goods sold just to illustrate both. But regardless, whether it's when we talk about this change in inventory, there's the cumulative effect on retained earnings, and then you have to imagine what is the other, and I want to be very careful here, because we made the change on January 1st, 2022, the key is you have to be thinking about permanent accounts, because we know that there is this effect on cost of goods sold. We know that's true, and ultimately there's an effect on income. But after every year, that cost of goods sold account is closed out, and it's closed to retain earnings. But there's this other part, which is the way that we handle our inventory account balance. And so there are really two permanent accounts that are affected by this change: retained earnings and inventory. If we had made this change, let's say partially through the year, then there could be some temporary accounts as well. I'm not going to have that for tests or anything like that, but I just want you to be aware that depending on when you make the change, there could be temporary accounts affected as well. But since we implemented the change at the beginning of a year, we don't have to worry about it. It's just going to be permanent accounts, and so those two permanent accounts are retained earnings and inventory. And so it's really key that you think about permanent accounts. The most common mistake that I see from students whenever they're doing the journal entry, they want to think about temporary accounts. They want to think about cost of goods sold for this kind of example, but understand that account has been closed. And so you got to be thinking about the permanent accounts. All right, so with this journal entry, of course, there's an increase to our cumulative income, which means we need to increase our retained earnings. And of course, there's also then the increase to inventory in the same amount, $3,800. Now, the financial statements is probably where the challenge is a little bigger for most students, just most. And the reason why is because getting to that journal entry, of course, understanding the concept of what's going on is important. But now you've got to kind of get to the nuts and bolts of it and say, okay, now we've got to think about on December 31st, 2022, I'm going to have 3 years income statements and 2 years balance sheets to present. And I have to present any prior years as if I had always been using FIFO. And since I've always been using LIFO, there's going to be a restated amount for some, but not all accounts. And so what I've done here is I've given you the 2020 and 2021 income statements. And so we have these 2 years, and this is what was originally reported when we had used LIFO. Now we've got to think about what will be restated amounts for each of these accounts. And so what I'm going to kind of throw in here is that reference, sort of looking back at that prior information, looking at the change in income year over year. And so we can see that there's a $2,000 difference in 2019, there's a $500 difference in 2020, and there's a $1,300 difference in 2021. Notice at the end of 2022, though, you only have to present 2020 and 2021, along with, of course, 2022. And then as far as the test is concerned, I had a student ask, well, how is this going to look on a test? Essentially, what you'll be given is that as reported column, and then you'll be required to fill out the restated column. And so you'll be given the as reported amounts, and then you'll need to provide the restated amounts. And so anything that you see blank here would also be blank or something similar on the test. I will admit, as I've written the test, one thing that I changed, just so you're aware, not changed is probably not the right word, one thing I've simplified is rather than having lots of different accounts, I'm going to be using kind of broad categories. So I might have like revenues, total revenues. I might have total expenses, and sort of rather than having to distinguish which accounts, I'm going to make it a little bit easier in terms of just understanding what you need to put into it. But I will be creating some practice problems on Canvas that will get right at the way the test will be formatted. So there's a little more detail that I'm requiring or that I'm providing in the lecture than what I'm going to require on the test. So anyway, so anything you see blank, that's what we're after here. And so as we move forward, first of all, we know that when you're changing the way you count for inventory, that's not going to change the sales revenue that you record. And so those are kind of easy points, just filling in the restated amounts being the same as what was originally reported. However, cost of goods sold is going to change. In the first year that's presented is 2020, and there's a $500 difference in net income. And so what you have to imagine is, well, what is the effect effect on cost of goods sold. If income goes up, it must be the case that cost of goods sold went down for that same amount. Again, in this particular example, we're ignoring tax effects, so that makes it a little bit easier. And so our cost of goods sold, rather than being $53,000, would be restated as $52,500 in 2020, and then that same $1,300 difference in 2021. And so rather than me sort of give you the answer right away, I want you in your own mind to think about, okay, what would that restated amount be? And so if it was originally reported $59,000, and you can see the difference in income is $1,300, what would be reported as the restated amount? And so it's sort of in your own computer there, or by yourself, just sort of the count of three, I'm going to kind of give you, if you want to put it in the chat, see if you got it right, that's fine, or you can just say it out loud at home or whatever, but on the count of three, give me your number. 1, 2, 3. And the answer is $57,700. Hopefully you were able to get that. Again, the cost of goods sold number would decrease by $1,300. All other expenses are the same. This is only one account, so we don't have to worry about other expenses. And of course, that means that our net income in 2020 stated as $12,300 in 2021. Okay. All right, so I'm going to give it a second to catch up. Some of you are getting it right. That's good. I think I can change the latency in future streams, so I'll be doing that in the future. All right, let's make sure my audio is still working. Okay, everything's still working. So basically we use, the question is, we use net income to derive cost of goods sold. Yes, in this problem, absolutely. That's what we have to do. Okay, now I'm going to move on. If there's more questions come up, I can always go back, not a big deal. All right, so now with the balance sheet. So we had the income statement where you present 2022, 2021, and 2020. With a balance sheet, you only report 2 years. And so you, of course, would have the 2022, and that year is wrong. I missed that on the slide. Sorry about that. So it should be the 2022 financial statements on that sheet. Sorry. But all of that to say, so we'd have to report 2022 and also 2021. And we can see a list of different accounts here: inventory, other assets, total assets, liabilities, retained earnings, other equity, on and on. And so those are the as reported amounts, and again, we would need to provide those. Absolutely would need to provide those on the test, and so then we're required then to go with the restated amounts. And so again, there's a cumulative difference. Now this is probably where students will make a mistake. Let me go back to the previous slide just for a second. Notice that in 2020 the effect was only from the 2020 difference, and in 2021 the effect was only from the 2021 difference. And the reason why is because income statements are year to year. In other words, each year kind of stands alone. But as soon as you get to the balance sheet, they accumulate. And so any effect that you see on the balance sheet is going to be accumulated up to that point. And so in 2021, there were 3 years of differences that are going to all accumulate on this one change or restated amount on the balance sheet. And so originally we had reported $4,000. The cumulative difference is $3,800. So the restated amount would be $7,800. The other nice thing about this is that's also the journal entry amount. So if you remember, we had an increase to our inventory of $3,800, and so we need to increase our restated amount, $3,800, relative to the as reported amount. And so that's the whole idea here, is that you have this accumulation on the balance sheet, but year-to-year effects when it comes to the income statement. All other assets are the exact same, and total assets are $109,800. I'm just going to move what I'm looking at here real quick. Sorry. So again, the total assets are also increased $3,800. Liabilities are the same, $50,000. Retained earnings also increases $3,800. Again, that's part of that journal entry. Other equity is the same, and so of course the liabilities and equity also increase $3,800. And so you can see that there are several blanks here that you'd have to fill out. But some of them are kind of freebies. And so on the test, there will be some that there aren't going to be a change, but it's going to be broader than what I have here, just so you know.